Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, April 28th. Market sentiment has improved in recent weeks, but this has not changed our full-year view. The stock market outlook remains uninspiring, even though we expect stocks to end the year with a modest gain. The improvement in the stock market the past month reflects a squeezing out of excessive pessimism from the economic outlook. Fears of a deep recession have faded. It is now recognized that the severe weakness in the housing sector has not spread to other sectors of the economy. Manufacturing and consumer spending have been extremely resilient. The problems in the credit markets on Wall Street have not created a widespread credit crunch. Economic trends have been weak, but the economy has not imploded. The reduction of fears reduces a negative, but it does not create a positive. Economic growth will still be sluggish through 2008. That means modest corporate revenue growth. Profit margins will be pressured by rising costs. Interest rates are not going to drop further. That means stable rather than rising multiples. Stock prices should end the year higher than current levels, but a large, sustained rally is not likely. Inflation has become a major concern, earnings growth has been weak, and the Fed is perceived to be at the end of its interest rate reduction cycle. Valuation is hard to assess at present because the large write-offs in the financial sector distort the overall measure. The write-offs may end soon. The degree of earnings growth after that is highly uncertain. Nevertheless, the PE of 17 on trailing operating earnings indicates that valuations are not worrisomely high. This is one of those years in which long-term investors will need patience. The near panic of January has faded, but the outlook is moderate at best. Earnings growth will be sluggish all year, and profit margins will be pressured by rising labor and commodity costs. In 2009, the political climate could shift to policies favoring redistribution over growth. The tax rate on dividends is likely to increase, and that will necessarily reduce the current value of stocks. Nevertheless, we continue to believe that the way to participate in the wealth creation machine known as the U.S. economy is to own stocks. There are plenty of investors that first got into the market in the late 1990s and learned that stocks can go down. However, it is wrong to conclude that rising stock markets always mean a bubble and then a crash. Over the long term, the indices march higher. I'm Pat O'Hare for Briefing.com. Thanks for listening.